Today, we're diving deep into a topic that separates the consistently profitable traders from the crowd, something I call the essential Wall Street doctrine. We're going to talk about why your trading psychology is infinitely more important than any technical strategy you could ever learn. This is part one, the undying Wall Street vow. So what is this vow? It is a foundational truth that many traders learn the hard way. Technique is just a faint light in the vast, dark ocean of the market. Now, don't get me wrong. Technical analysis, fundamental analysis, they're crucial. They give you the map, the tools, the charts, and the data. But what good is a map if you, the captain of the ship, are panicking and steering directly into a storm? Your psychology is the compass that keeps you on course and the engine that drives your decisions. Think about it. We've all heard the Wall Street adage, the price discounts everything. It's a classic for a reason, but what is it that actually moves the price? It's not a mathematical formula, it's the collective emotion of millions of traders. It's the raw, unfiltered power of human fear and greed. When you see a massive sell-off, that's fear taking the wheel. When you see a stock skyrocketing on pure hype, that's greed and the fear of missing out, or FOMO in full effect. Let's dissect those technical indicators you spend hours studying. The RSI, the MACD, moving averages, what are they really? They are historical scars. They are footprints left in the sand by past price action. They project possibilities based on what has already happened. They're lagging indicators. Your psychology, on the other hand, is the real-time, present-moment force. It's the emotional jolt you feel when unexpected news breaks. It's the irrational urge to sell everything during a market panic. It is that desperate chase for a stock that's already up 300% because you can't stand to miss out. That is the living, breathing market. This brings us back to the vow, the core principle. Technique provides your edge, but psychology determines your execution. You could have the most brilliant, back-tested, genius-level trading plan in the world, but if you can't control your emotions when real money is on the line, that plan is worthless. A perfect strategy ruined by a moment of panic or a surge of greed is a losing strategy. Every single time. Imagine a highly skilled archer. They have the best bow, the straightest arrows, and they've practiced their shot 1,000 times. That's their technique. But right before they release the arrow, a gust of wind blows. That's unexpected market news. A fly lands on their nose. That's a distracting thought about a past loss. Their heart starts pounding. That's fear of losing money. If they can't maintain their composure, their focus, their psychological calm, the arrow will miss the target, no matter how good their equipment or training is. In trading, you are that archer. Your analysis gives you the target, but your mindset pulls the string and releases the arrow. I've seen traders with mediocre strategies make consistent money because their discipline is ironclad. And I've seen trading prodigies with brilliant systems blow up their accounts because they couldn't handle the emotional pressure. They let their fear dictate their exits and their greed dictate their entries. So, how do we start to master this? The first step is acknowledging it. You must accept that you are not a robot processing data. You are a human being with a complex web of emotions, biases, and ingrained responses. The market is designed to trigger these responses. It's an arena that preys on your psychological weaknesses. The moment you start treating your own mind as the most important variable in your trading equation, you've taken the first step toward true consistency. Instead of asking, "What's the best indicator?" start asking, "What are my emotional triggers?" Instead of searching for a holy grail strategy, start building a holy grail mindset. This means developing self-awareness. It means knowing when you're feeling fearful and having a plan for it. It means recognizing when you're feeling greedy and having rules to keep yourself in check. This is the real work of a trader. The charts are the easy part. Managing the person staring back at the screen, that's the challenge. The market is a mirror that reflects your internal state. If you are chaotic and undisciplined on the inside, your trading results will be chaotic and undisciplined on the outside. But if you can cultivate inner calm, discipline, and resilience, you'll see that reflected in your P&L. This is the undying vow of Wall Street's most successful players. They honor their psychology above all else. They know that a strong mind is the ultimate edge. When we talk about trading technique, what are we really talking about? We're talking about systems, rules, and logic. It's the structured framework that transforms trading from a wild gamble into a calculated business. It's what gives us our entry points, our stop-loss levels, and our profit targets. Essentially, technique is the tool we use to bring objectivity into a world often driven by emotion. It's our attempt to tame the chaos of the market. Without a solid technique, you're just a ship without a rudder, tossed around by every wave of market sentiment. It provides the map and the compass for navigating the treacherous waters of the financial markets. Let's start with the most visible part of any technique: chart analysis. Whether you're drawing trend lines, identifying support and resistance, or using indicators like the RSI and MACD, the ultimate goal is the same. It's about building an objective strategy. You're no longer just guessing, "I think this stock will go up." Instead, you're saying, based on this bullish divergence and the break of this key resistance level, the probability of an upward move is high. Chart analysis takes the guesswork out and replaces it with a logical, repeatable process. It's what allows you to look at a chart and see a plan of action rather than just a confusing mess of squiggly lines. It's your first line of defense against making purely emotional decisions. But here's the cold, hard truth that every seasoned trader knows. Chart analysis is imperfect. It's not a crystal ball. You will encounter false signals. You'll see what looks like a perfect breakout, a fake out, only for the price to reverse violently and stop you out. You'll have a pristine technical setup, only to have an unexpected news announcement or a sudden shift in market sentiment completely blow it out of the water. The market doesn't always play by the rules of logic drawn on a chart. It's influenced by fear, greed, and a million other human factors. So while technical analysis gives us a vital edge in probability, we must accept that it will never be 100% accurate. The fatal limitation is its inability to account for the irrationality of the real world. Now let's talk about the single most important technical element for survival: risk management. This is the unsung hero of every successful trading account. We're talking about defining your risk-to-reward ratio. For example, a classic rule is to never risk more than you stand to gain, often aiming for a ratio of 1 to 2 or 1 to 3. This means for every dollar you risk, you're aiming to make at least $2 or $3 in profit. The ultimate role of risk management is capital preservation. It establishes clear rules that protect your account from being wiped out by 1 or 2 bad trades. It is the financial firewall that allows you to stay in the game long enough for your winning strategy to play out. Think of it as the seatbelt and airbags in your car. You hope you never need them, but they're what save you in a crash. However, even the most robust risk management plan has a fatal flaw, and it's a human one. It cannot prevent the destructive behavior of revenge trading. Have you ever had a trade go against you, hit your stop loss, and felt that burning desire to immediately jump back in, maybe with a bigger position size, to win your money back from the market? That's revenge trading. It's when a trader, stung by a loss, completely abandons their own rules. They throw their carefully calculated risk-to-reward ratios out the window and start gambling, driven by ego and frustration. Your risk management system is just a set of rules on a piece of paper. It has no power to stop you from breaking them. When emotion takes the driver's seat, risk management gets kicked to the curb, and that's when accounts get blown up. This brings us to the final piece of the puzzle, the trading system as a whole. A complete trading system integrates your chart analysis with your risk management into a cohesive, structured set of rules. When should you enter? When should you exit? How much do you risk? A well-defined system answers all these questions before you even place a trade. Its ultimate purpose is to provide discipline and consistency. It allows you to operate like a machine, executing your plan flawlessly, trade after trade, without second-guessing. A validated system that you trust is what enables you to manage trades with confidence, knowing you're following a plan with a positive expectancy over the long term. It's the engine of your entire trading operation. But what happens when that engine is put under extreme stress? When the market becomes wildly volatile, when prices are swinging up and down in a way that defies all logic, panic can set in. On the flip side, after a long winning streak, overconfidence can creep in, making you feel invincible. In these moments of extreme psychological pressure, the fatal limitation of any system becomes apparent. Traders will discard their validated, time-tested system for impulsive gut-feel actions. Panic leads to selling at the bottom, and overconfidence leads to buying at the top or taking on way too much risk. The system is only as strong as the person executing it. When human emotion overrides the machine-like discipline the system is designed to provide, even the best system in the world is rendered useless. So, let's bring it all together. Technique, comprising chart analysis, risk management, and a complete trading system, is absolutely essential. It's the tool of cold reason that gives us an edge, protects our capital, and provides the discipline needed to succeed. It transforms trading from a guessing game into a strategic enterprise. But as we've dissected, each component has a fatal limitation, and that limitation is almost always human emotion. Your charts can give you false signals, but it's your frustration that leads you to chase losses. Your risk management rules can protect your capital, but it's your ego that leads you to revenge trade. Your system can provide discipline, but it's your panic or greed that leads you to abandon it when you need it most. Understanding this is the key to unlocking the next level in your trading. It's not about finding a perfect system that never fails, that doesn't exist. It's about building a robust technique and then, crucially, mastering the psychological discipline to follow it, especially when it's hardest to do so. Your technique is your sword and shield, but you are the warrior who wields them. The best tools in the world are useless if the warrior is overcome by fear or rage on the battlefield. But let's get specific. When people hear psychology, they often think it's just about controlling fear and greed. While that's part of it, the real unbeatable power lies in one word: discipline. Trading psychology isn't about feeling good all the time. It's about maintaining discipline and patience, not just for one trade, but through thousands of them. It's about mastering what I call the science of doing nothing when the market is a mess and offers no clear edge. Knowing when to sit on your hands is a skill that saves more accounts than any fancy indicator. Think about the giants on Wall Street. A major hedge fund rarely goes bankrupt because its trading system was flawed. They have teams of PhDs for that. They go bust because of catastrophic emotional risk management. One impulsive, ego-driven decision from a single portfolio manager can erase an entire year of painstaking work from hundreds of people. That's how powerful or destructive our minds can be. This is why, in the world of high finance, discipline isn't just a virtue, it's the ultimate survival tool. It's what separates a long, prosperous career from a brief, spectacular flameout. Let's bring this down to a practical level. Your technical analysis, your charts, your system, it all tells you what to do. Maybe it says, buy here, but that's just the start. It's psychology that dictates how you do it. Psychology is what helps you actually click the button and buy the correct position size, not too big out of greed, not too small out of fear. When the trade goes your way, it's psychology that gives you the fortitude to hold on and let your winners run, instead of snatching a tiny profit because you're scared of giving it back. And most importantly, when the trade goes against you, it's psychology that forces you to cut your losses decisively, just like your plan says, instead of hoping and praying it turns around. These are the core tenets of every successful trading book. Let winners run, cut losers short. Your technique requires it, but it's your psychological discipline that allows you to execute it. And sadly, this is where 90% of aspiring traders fail. They have the map, but they can't make themselves follow it when the terrain gets rough. Think of it this way. Technique is the shiny, powerful engine in a race car. It's what gives you speed and performance. But psychology is the driver. The driver knows when to accelerate, when to brake, when to be patient in the corners, and when to push the limits on the straightaway. A great engine with a poor driver will crash. A decent engine with a world-class driver can win championships. This is why you see traders with incredibly simple systems make fortunes, while others with complex, perfect systems consistently lose money. The difference isn't the system, it's the person executing it. The discipline to stick to the plan, trade after trade, day after day, is the true secret sauce. Wall Street and trading in general is a marathon, not a sprint. Your technical skills help you run fast, giving you an edge over short distances. But psychology is your endurance. It's what keeps you going. It's what helps you get back up and follow your plan after a brutal losing streak, what we call a drawdown, when every instinct is telling you to quit or change your system. It's also what keeps you grounded and prevents you from becoming reckless and complacent after a massive winning streak, when overconfidence is whispering in your ear that you can't lose. Technique gets you in the race. Psychology ensures you finish it. Without that mental endurance, the inevitable ups and downs of the market will wear you down and take you out of the game, guaranteed. So, how do we build this unbeatable power of discipline? It starts with radical self-awareness. You need to treat your trading like a science experiment, and you are the primary variable. This means keeping a detailed journal. And I don't just mean logging your entries and exits. You must log your emotions. Why did you take that trade? Were you bored? Were you chasing a loss? Were you feeling euphoric after 3 straight wins? You have to document your mental state before, during, and after each trade. This data is more valuable than any price chart because it reveals your personal patterns of self-sabotage. Once you see the pattern, I always take oversized risks after a big loss, you can create rules to counteract it. For example, a rule might be, after 3 consecutive losses, I must walk away from the screen for 1 hour, no exceptions. This isn't about wishful thinking. It's about building a structured, rule-based system to protect you from your own worst impulses. Another crucial aspect is creating a pre-trade ritual. Just like a pilot runs through a pre-flight checklist, you need a process that centers you and confirms your plan before you risk a single dollar. This could involve reviewing your overall market thesis, checking the economic calendar, and most importantly, rereading your core trading rules. Remind yourself what a high-probability setup looks like for you. Ask yourself, does this trade meet all of my criteria, or am I forcing it? This moment of pause acts as a firewall between emotion and action. It forces you to switch from your impulsive emotional brain to your logical, analytical brain. This simple habit can be the difference between a disciplined, professional execution and a costly, emotional mistake. It's about creating an environment where discipline is the path of least resistance. Finally, understand that discipline is like a muscle. It gets stronger with use. You won't be perfect overnight. You will make mistakes. The goal isn't perfection, it's consistent improvement. When you violate a rule, don't beat yourself up. Instead, get curious. Go back to your journal and analyze what happened. What was the trigger? What can you do differently next time? Every mistake is a tuition payment to the market. Make sure you learn the lesson you paid for. Celebrate the small wins, not just the profitable trades, but the times you followed your plan perfectly, even if the trade was a loss. Praising disciplined behavior reinforces it. Over time, through conscious practice, journaling, and self-analysis, that undisciplined emotional amateur slowly transforms into a calm, collected, and consistently profitable professional. That is the true power of trading psychology. All right, let's dive into the minds of the giants, the legends of Wall Street, and unpack their playbook. You see, after all the charts, all the algorithms, all the economic forecasts, what truly separates the winners from the losers? It's all in your head. The game isn't played on a screen, it's played between your ears. Let's start with the OG, the original titan of speculation, Jesse Livermore. This guy was trading over a century ago, and his wisdom is more relevant today than ever. He famously said, "There is nothing new on Wall Street because speculation is as old as the hills." What did he mean? He meant that the technology changes, the assets change, but human nature, that's a constant. The same fear that caused a panic in 1907 is the same fear that triggers a crypto crash today. The same greed that fueled the dot-com bubble is the same greed that pumps a meme stock. The tools might be different. We've swapped ticker tapes for high-frequency trading bots, but the emotional engine driving the market, fear and greed, is absolutely eternal. Livermore understood that if you can master your own emotions, you can master the market, because you understand what's driving everyone else. It's not about predicting the news, it's about predicting the human reaction to the news. Now let's fast forward to a modern legend, the billionaire fund manager Paul Tudor Jones. This is a man who has navigated some of the most volatile markets in history. His secret weapon isn't a magical indicator or a secret formula. It's a simple, profound philosophy. He says, "I always assume every position I have is wrong." Think about that for a second. This isn't pessimism. It's the ultimate form of risk management. When you enter a trade assuming it's wrong, what do? You don't bet the farm. You define your exit point before you even enter. You stay humble. You stay vigilant. Your ego isn't tied to being right. Your survival is tied to protecting your capital. Jones uses technical analysis to find good entry points, sure, but he uses his psychological discipline to stay in the game. He knows that one big loss, driven by ego and the refusal to admit you're wrong, can wipe out 100 small wins. So for him, psychology isn't just part of the strategy, it's the shield that protects his entire fortune. It's about playing defense first. So we have Livermore, who mastered his understanding of human emotion, and Paul Tudor Jones, who uses humility as his primary defense. But what if there's another way? What if the best way to deal with the pitfalls of human psychology is to remove the human altogether? Enter Ray Dalio, the founder of Bridgewater Associates, the largest hedge fund in the world. Dalio looked at the chaos of human emotion and decided, "I want no part of this." His solution was radical and brilliant. He set out to build a machine. He and his team created systematic algorithmic trading models that make decisions based on data and predefined rules, completely free from human fear, greed, or ego. Think of it as creating the perfect trader, one that never gets tired, never gets scared after a loss, and never gets euphoric after a big win. It just executes the plan flawlessly over and over again. Bridgewater's entire empire is built on this principle of radical truth and mechanizing the decision-making process. They essentially solved the psychology problem by automating the human out of the equation. This is the cutting edge of modern finance. While individual traders still wrestle with their own minds, the biggest players are building systems to bypass that struggle entirely. So what can we, as individual investors and traders, learn from these three titans? We see a clear progression. First, you have Jesse Livermore, who tells us to understand and master the timeless emotions that drive the market. His edge was psychological awareness. Then you have Paul Tudor Jones, who shows us how to build a defensive psychological framework based on humility to protect our capital at all costs. His edge is disciplined risk management. And finally, Ray Dalio presents the modern solution. If you can't beat your own emotional biases, build a system that operates without them. His edge is systematic automation. The common thread? The supremacy of psychology. Whether you're mastering it, defending against it, or engineering it out of the process, dealing with the human element is the final boss in the game of investing. You can have the best strategy in the world, but if your psychology is weak, you're destined to fail. The market is a mirror, and it will reflect your own emotional flaws right back at you, magnified 1,000 times. So, the next time you're about to make a trade, ask yourself, am I acting on a solid plan, or am I being driven by fear of missing out? Am I holding this losing position because my analysis says so, or because my ego can't handle being wrong? Answering these questions honestly is more valuable than any chart pattern. Think of trading like a pyramid. The base, the foundation, is your technical skill, your IQ. You absolutely need it to understand the market, to spot a potential trade, to know the rules of the game. It's your entry ticket. But what sits at the very top, the peak of that pyramid, determining whether it stands tall or crumbles under pressure? That's your psychology, your emotional intelligence, your EQ. Technique is necessary, but psychology is what's truly decisive. I've spoken with elite traders, the ones who consistently win year after year, and when you ask them what separates the good from the great, the answer is always the same. A top-tier Wall Street trader is someone with solid technique, of course, but what makes them unbreakable is their psychology. Their technique tells them what to do: buy here, sell there, hold this position. But it's their psychology that gives them the power to actually do it. Especially when every headline is screaming, every expert is panicking, and their own gut is churning with fear or excitement. It's the ability to stick to the plan when the world is telling you to abandon it. That, my friends, is the perfect harmony of skill and mindset. If you had to put a number on it, many on Wall Street would point to the famous 80-20 rule. They believe that 80% of trading success comes from psychology and risk management, while only 20% comes from the specific technique or strategy you use. Think about that for a second. 80%. Your technical analysis helps you find the golden opportunity, but it's your psychological strength that lets you hold on to the profits. It's what stops you from selling too early out of fear or holding on too long because of greed. Technique gets you in the door. Psychology lets you stay in the house and not get thrown out. So, what's the ultimate lesson here? The biggest battle you'll ever face on Wall Street isn't against the market. It's not a fight against algorithms, hedge funds, or complex indicators. The real battle, the one that defines your entire career, is the battle against yourself. It's you versus your own fear, your own greed, your own impatience, and your own ego. The market is just a mirror reflecting your internal state back at you. Only when you conquer those inner demons, that voice telling you to chase a bad trade or panic sell a good one, can you truly conquer the market. Your mindset, your emotional discipline, your psychology. That is your biggest and most valuable capital. It's more important than the money in your account, because without the right mindset, that money will eventually disappear. But with it, you can build a fortune. Thank you so much for watching this series and for joining me on this deep dive. I hope it's given you a new perspective on what it really takes to succeed. If you found this valuable, please give this video a thumbs up and hit that subscribe button so you don't miss what's coming next. I'd love to hear your biggest takeaway in the comments below. Until next time, trade smart and stay disciplined.